Earnings seasons just kicked off Friday, the first quarter for 2019. Earnings expectations are low among investors. Let's see, Friday, JP Morgan and Wells Fargo start off the earnings seasons with beating expectations, both top and bottom line. JP Morgan stock rose 4.6%, while Wells Fargo was down 2.6%. That was because it showed weakness in its consumer lending business, and the new interim CEO, Alan Parker, downgraded the outlook. Overall, investors are expecting I think consensus was some 2.5% decline in earnings growth for 2019. That's because of the trade spats that was previously just US and China, now US and Europe possibly. And also the waning effect of the tax cuts that were given to US companies 2 years ago. Now, how should investors navigate through this market environment with such high volatility that is to be expected? My view has always been to stay invested and be prudent in your investing while following your game plan to achieve your individual goals. So it's not about absolute market returns, because if you're chasing absolute market returns, investing in stocks or bonds is not part of the strategy. You have to use leverage as well. Therefore, investors should stay invested and add any additional new capital into bonds, either corporate, high grade, or government securities and real estate investment trusts. The rationale behind that is because when markets get a bit choppy, it's relatively safe to stay invested, but some investors might not be able to do that. So having that additional safety cushion underneath your portfolio might help. And the dividend and interest payments are also a plus. This uncertainty around politics, around Brexit, US China, and US Europe trade spats will continue to be headwinds for stock prices. Alternatively, if you're looking at why not just get out of the market right now, well, we're towards the end of the credit cycle, but we're not quite there yet. We won't be there until we're there, that kind of stuff. No one can tell. So it's more beneficial to stay invested in the market and play more defensively rather than just to take everything out and wait until the next bull market runs. Because we don't know how long that would be. If we look for alternatives, there are very little yield out there, very little returns, because bond prices are so low, interest rates are so low, so investors are compensated to take on more risk so that they can get higher returns to achieve their goals. The upside of investing for the long term is the certainty that you get with knowing the risk that you're taking on and also the rewards. But the downside is in the waiting. So I suggest that if you're waiting, just do yourself a favor and tune out all the financial news around you, because there will always be that big event that will supposedly end the world as we know it. And that's all for this video. Thanks for watching.